All right, everybody. This is Derek Ruiz, and I'm super happy today to be having a conversation with Mr. Bruce Jones, who is the CEO and founder of Tax Wealth, a tax planning organization. And Bruce, welcome. Great.
Thank you very
I know
much.
you have an extensive background. So why don't you go ahead and tell the audience, your background and experience.
Okay. Well, on a personal level, this is my 54th year in financial services. I started back in 1970, first got involved in tax planning in late 73. I was very fortunate in that I trained under a guy who did international tax planning, and I was actually cross trained in financial planning as well. Well, for 41 years until about roughly 8 or 9 years ago, I was also in the securities and financial planning industries while I was doing tax planning. I retired from financial planning and securities uh, about 8, 9 years ago. And instead of fully retiring, I decided to continue what I'm doing in tax planning because I thoroughly enjoy it. So I kept my company, which is called Tax Wealth. I founded Tax Wealth 36 years ago in 1988. And we are not a financial planning firm. We are a tax analysis and solutions research company where we come and support in proactive tax planning to CPAs and attorneys and financial advisors of all types to help solve their clients' tax concerns when they're selling capital assets, be it real estate, a business, or whatever it might be. And we do a lot of work as well in mitigation of income taxes for the high income W 2 wage earners and those who are self employed in
Got
businesses.
it. So I'm looking at your website, and it says leverage the tax code, and it says that Congress has enacted laws that provide significant tax incentives, but these opportunities often remain hidden within the intricacies of the tax code. So what you're saying there is there are things in the tax code that you know about that can be leveraged to help people plan their taxes better and maybe eliminate or reduce some taxes. Is that correct?
That's correct. There's over 70,000 active pages through the tax code today. No
Right.
one knows it all, nor do I.
Well, but you just
Nor do
focus on
I.
the part that helps your
That's why
clients. Got it.
that's right. The first thing we do is identify what the needs are, the temperament of the client, their goals and objectives, everything about them that we can learn about them. And then we delve into law to find solutions for their specific situations. One thing that's very important, Derek, is that there's no one size fit all in tax planning for individuals. Everyone is different. Everyone should be treated differently because of that. So whatever is done should be tailored specifically to their needs and their temperament and their to meet their
Got
goals
it.
and objectives.
So again, Tax Wealth is a tax analysis and solutions research firm, combining your experience
Right.
with AI-driven technology and an extensive network of hand-picked tax professionals to discover, validate, curate, and execute unique strategies that leverage these hidden opportunities in the tax code. So, when harnessed, our robust tax code compliant catalog of strategies for past, present, or future tax scenarios enables our partners and clients to significantly reduce or even eliminate income and capital gains taxes. That almost sounds too good to be true, Bruce. I got to tell you, I know it works and everything, but God, for the average person listening to this interview, it's like, come on, how's that possible? I mean, I'm sure there's a lot of skepticism. Um, and you even have mentioned to me that you even have tax strategies for people that have sold an asset and closed on the asset and would owe capital gains taxes, but you have a solution for that. I don't want to go into that solution right now. I want to keep the focus on where we're at right now, but I can't wait to hear more about that.
Well, we can certainly touch on that, and there certainly are ways of being able to go back and recapture
Right.
taxes within reason. or the particular transaction that we talked about the other day had to do with a person who sold a bunch of
Well, wait,
property
wait,
earlier
Bruce.
this
But
year
I don't mean to
without doing.
interrupt. I got a couple of things I want to go through before we start getting into the real guts and some of these incredible stories you have. So before we go any further, what services does Tax Wealth provide its clients exactly?
Well, first of all, understand that the vast majority of the clients we serve are other advisors.
Look, financial
The vast
planners.
majority, I'd say probably financial planners, real estate brokers, business brokers, CPAs, enrolled agents, accountants,
So
wealth managers, certified
those are your
planners.
clients because they bring you people that need your tax services, correct? Okay. So
Yes.
I get you. I get who you work with. You know, financial planners, CPAs, all that stuff. What services do you provide their clients exactly? I want to just define what it exactly you do for them.
Well, what we do for them, once again, as I said earlier, once we identify what their specific needs are, then we find solutions for that need. For example, if they're selling a capital asset like real estate or a business, then we identify what their specific transaction is all about, what the projected taxes are, where those taxes come from, how much they would net out in after tax profit if they don't do any advanced planning. And then we come up with one or more solutions that we know are supported by law to solve the tax problem and maximize the profit that they end up with after escrow closes. If we're dealing with income tax savings, then we want to identify how much in gross income that they're receiving, adjusted gross income, the amount of deductions that they're taking, what those deductions are, how much their net taxable is, and then we find the right strategies to accommodate that need to mitigate their
Okay,
income
so
taxes.
it seems to me like there's two things. You help people with their capital gains problem when they want to sell an apartment building, a business, a industrial property, whatever asset, and they want to eliminate or their capital gains taxes. You can help them with that, correct? Okay. And then the other
Yes, we
thing
can.
is if you have people that are earning a lot of money and they need help with, I guess, reducing their income tax, is that correct? You help them with that as well.
Yes,
Wow, that's pretty
correct.
amazing. I never heard anybody that really did that. You know, that's a pretty amazing thing. Now, so you're probably getting a lot of referrals from financial planners, enrolled agents, CPAs that have clients that are going to have a tax problem, and they can say, "Look, I'm going to call Bruce. I'm going to set you up. Bruce is going to help us. He's going to solve your problem." That's pretty much how it works for a lot of people. A lot of referrals.
Well, we're going to identify what their problem is first and then find how best to solve the
Got
problem.
it.
So we want to give them what their choices are. As I said earlier, there's no one size fit all. So we want to give them the best choices that we know are supported by law that they can consider along with their CPA, along with their attorney, along with their advisor. They're more than welcome to be part of this process and should be. But it's important to understand what each of the roles are of each of the advisors that are serving them, meaning the client. Most CPAs and accountants are not tax planners. They've never been trained in it. I refer to them as financial historians. Now, that's not a slam against them, it's just fact. They take information that has already occurred by the client, filter through the laws that they need to filter through to come up with an accurate tax return. And of course, that is very, very important. But that is not tax planning, that's accounting. Generally, in my experience, the CPAs view tax planning as perhaps inviting their clients to come in to their office, maybe the last quarter of the year, projecting out what the taxable income is, making adjustments to that for withholding, and maybe suggesting they might buy a computer or some other equipment before the end of the year to get some write off. Again, that's much more allocated toward accounting than it is effective overall proactive tax
Got
planning.
it. And so it, you work with a lot of other, I guess, handpicked, very smart professionals to help you put all this stuff together, correct?
We do, yeah. Yeah, we're very collaborative. As I said, no one knows the entire tax code. I don't. No one does. So what we do, we collaborate with other professionals who are specialists in their specific areas in their craft, and we work collaboratively with them to solve the solutions that need to be solved. And again, in line with what the client themselves need to be comfortable with, because ultimately they're the ones who make the decision. No one else, nor should anyone else make the decision for them. So they need to sleep comfortably at night with the decision that they make, but that can only be based upon being educated first to
Got
make
it.
an informed decision.
So you work with attorneys that help you with this stuff that specialize in tax planning and stuff?
Yeah.
Got it. Okay.
Yes.
Well, a lot of the audience watching this are probably people that own rental properties or other capital assets, perhaps businesses. But literally, you could help a seller that would normally have a huge capital gains tax bill. Let's say he sells 20 units in West LA. He's going to owe more than $1 million. You can actually eliminate the capital gains problem for that individual. Okay.
It's
Can
possible.
you elaborate on the methodology or what it's called or how it works? Just, not detail, but just give us the
Well,
basics.
okay. Well, let's go a little generic here. One plan approach that we use, I call it the 100 to 1 plan because that's indicative of what it accomplishes. Under law, we can take 100% of the taxable gain and a sale bring it down to
Wow.
1%. You have the seller added income tax deductions to help, which would offset the rest of the taxable income that they have on the sale, plus income taxes would be saved. And the sale proceeds go into an environment that is creditor protected and free of estate taxes, which the client themselves fully control to reinvest however they
Got it.
choose.
Okay. Is there some kind of charitable thing involved with this methodology?
Yeah. There is a charitable component to it. It is not a charitable remainder trust. That's what most advisors default to. And I've done several of those through the years as well. And they can be very effective. But with a charitable remainder trust, the generating the tax deduction is entirely different than what the deduction is that is generated through this particular plan approach. And this particular plan approach is not new. It's been around for 30 years. It's just not that
Got
well
it.
known.
Yeah, well, I'm sure the government doesn't want people to know how they can eliminate taxes, right?
Well, the government is not in the business to
Right.
save your
Yeah, definitely
taxes.
not. They're there to take your
The
taxes.
IRS never give
Um,
you, no, the IRS will never give you
got
the
it.
ways to do that.
What is
They
your
do that.
typical client profile? Like, who's coming to you for this stuff?
That's a very wide range of folks. Everyone has different needs and different concerns. We have clients that range anywhere from a sale of $1 million or $2 million on up. We got a couple cases now for
$100 million?
$100 million. So it's yeah, on sale. So it's a very wide range. We have folks, and I think it might be appropriate here to touch on that one case that you and I had talked about. This gentleman had sold property earlier this year without doing any advanced planning. In his case, he had over $6 million tax,
So,
not
excuse me,
taxable,
Bruce.
but
So,
tax.
this gentleman, is this a Chicago guy? Or, anyways, doesn't matter. But he
Yeah.
sold property before he did any tax planning, and he was just thinking, I'm just going to have to pay the bill, the tax bill.
Well, he had some other thoughts in mind. He did not want to do a 1031 exchange, and that was and is not uncommon for property owners to only know about as
So, in
a
his
possible
mind,
solution.
he
He
just
was
going to have to pay the tax man.
when he sold the properties, yes, but then he had an afterthought about that to see if there was any way that he could go back after the sale to
Bruce,
mitigate the
do you know
taxes.
why he was selling that asset?
We had owned it for several years, and he thought it
Okay.
was the optimum time to
So,
sell.
so after the sale, he's kind of like, Is there any way to get out of this? Right? What can I do? I mean, is it too late? Most people would think it's too late. You closed escrow, it's done. But how did he find out about you?
He was referred to us through another advisor whom he works with, and that's exactly what his CPAs and tax attorneys thought. The deal was concluded, the escrow is closed, doing tax planning, there's nothing that could be done. And they were wrong. So when we got together on our Zoom call, the first thing he actually told me, he's a very, very nice man, very nice man. He told me, he says, look, I've talked to other advisors, and the things that they said that they could do, I think they should be in jail for what they could do. When we first got on a call together, he told me that his CPAs and his tax attorney said that there's nothing that could be done because he'd already closed escrow. And I told him, I said, well, had we talked before you sold, we could have eliminated taxes. Well, that sort of caught his attention. And of course, I was referring to what we were just talking about on the 100-to-1 plan. I said, however, you're in a post-sale situation. It's a lot easier to do planning for pre-sale transactions. However, for a post-sale transaction, you can use the same planning approach for other assets that you own without needing to sell them into the same structure and reduce your adjusted gross income by half, which effectively reduces your taxes by half, and then couple that with another plan approach to eliminate the rest of the taxes.
Wow.
And that's what he did.
I guess you're his hero.
He's pretty happy with me.
So you have a wide variety of clients. It could be people selling businesses or partnerships or all kinds of real estate. Now, I know in other types of tax strategies like the 453, the person has to have the property in an LLC or a corp, I believe. But is there any? Does that need to happen here with this strategy? They have to have it in an LLC or something for the 100-to-1
strategy. Yeah. Basically, what happens with that is that a single member LLC is set up, and the property is transferred into the LLC. There's no tax impact because the IRS considers it what's called a disregarded entity. And then the asset is appraised by an IRS approved appraiser for estate planning purposes. Then what occurs is that the client who owns the LLC as managing member, owns 100% of it, then gives away 99% of the limited partnership units of the LLC to a charity. And that's going to generate a huge tax deduction. In general, they're going to get up to 80% of the value of that asset, net of any debt, and other charitable tax deduction, which is up to 50% of their adjusted gross income. Any deductions that are not used for that current year that is above that figure can then be carried forward for up to 5 more additional years.
Now, when you say income, you're going to deed it to a charity, this is a charity you control?
No.
Okay.
You can't control a charity, no. But what they're not
gifting,
they're gifting the limited partnership units of the LLC to the charity. And they can choose any charity they want. We have some suggestions that we ask them to consider as far as which charity to use for specific reasons. But nevertheless, the charity ends up with that 99% of the LLC. However, keep in mind that what they're getting are non-voting, non-control interests of the LLC. See, and that's what allows us to reduce the taxable gain from 100% to 1% because taxability follows ownership. And when the asset is sold, it's the LLC selling the asset, not the original owner. And they own 1%. So they're going to get 1% of the transaction. And the charitable tax deduction that they get will offset that. But because they're managing member controlling the LLC and the assets in the LLC, after the sale occurs, all the sale proceeds are retained by the LLC under their full control that they can turn around and reinvest however they choose.
Simple, right?
Well, there's some moving parts to it, but on the surface, when you first are introduced to it, it sounds like very convoluted, but it really isn't. It's really very, very
um,
straightforward.
what happens if a a property that somebody wants to sell is highly leveraged? They have maybe 70% loan to value on it. It's worth 10 million and they owe 7 million on the property. So how is that handled?
Like any other transaction, the debt's going to be paid off
Okay,
at close of escrow.
that's simple. You don't have to. There's no like
Yeah,
mortgage replacement like in a 1031 exchange or nothing like that.
no. You know, if I may, let's speak on the 1031
Sure.
exchange for a moment, if I may. It's been around for decades, but unfortunately, that's for property owners, that's the only thing that they hear about as a possible solution. And the mantra that goes with it is you swap until you drop, which means you keep doing it. Every time you sell, you keep doing an exchange into one, a property that's higher, equal or higher in value, and you're always deferring the taxes. And then you die. Then under current law, there's a step up in basis to the value of the properties, and your heirs who receive the property, if they sell for that value, then there's no taxes to pay. That's the tenor of it. But what if a person wants out of real estate and they don't want more? Well, that's not a solution. Or let's say that the market conditions are such that they want to wait beyond 6 months after the close of escrow on what they sell. So if they can find another property, or if it's even worthwhile going into another property, or even finding a property that's worthy of going into. Well, if they go beyond that 6 month period, it's not a solution because of the restrictions that are involved in it. I think one of the most important things, however, to understand about a 1031 exchange is that one of the requirements, in addition to identifying property within the first 45 days after close of escrow, which is not easy to do,
Very
as you
tough.
well know, but in addition, they have to carry over what is called their net adjusted basis of the property that they're selling. And that becomes a new basis for the property that they're buying of equal or greater value through the exchange process. Well, the longer they've owned the property that they're selling, the less that net adjusted basis is going to be. That's defined as your original purchase price plus capital improvements minus depreciation. So let's say that they've owned it for 25 years. Here's an example. I had a real estate broker actually in Ontario who herself was an apartment owner. She owned the property for 30 years. Uh, she sold the property for $1,250,000. She had depreciated that property down to land value of $68,000. She found another property that she wanted to buy for $1,200,000 or greater, but had she bought it through the exchange, she would have had to carry over that 68,000 as a new basis for the property of $1,200,000 or greater, and she would have had no benefit of depreciation at all in the up. And you are very aware, every property owner is very aware of the importance of depreciation on investment property. So the better choice for her was to use a different plan approach, which was done. And she solved the tax issue, turned around and used the proceeds she got from that to buy the very same property apart from the exchange and got 100% reset on the depreciation benefit.
Awesome. um, what about highly appreciated personal residences? Let's say that you and your husband or your wife or whatever bought a Bel Air mountain property in 1972 for $100,000, and today it's worth 12 million bucks. So they got a huge capital gain on that. Is there a solution for that scenario?
Okay, well, in either event, yeah, we can certainly accommodate that as well. We've done personal residences using the 100 to 1 plan, for example, if it made sense. But what you want to keep in mind too is the homeowner's exclusion that's available to them. And if they're married, that's up to $500,000. So what we oftentimes do is separate that amount out from the planning approach so that they have that cash, and then put the balance of the sale into the planning approach that we use to solve the tax issues. so they have immediate cash that way, tax free, and then cash flow through the other processor, or actually have access to the sale proceeds, depending upon what they want to
Got it.
accomplish.
um, okay, let's switch gears a little bit from how you're helping individuals to why don't you explain your new what would you call it? Your new service for financial planners, for CPAs that want to work with you a little closer and be part of your team so they can bring these tax planning strategies to their own clients.
Well, what you're referring to is Tax Wealth Alliance. And that's where we literally partner with the CPAs and the attorneys and financial advisors out there. And we become their back office tax planning department. So what we do is bring to them a higher level of planning capability that they can serve their clients with. And we bring a lot to the table for them in support, tremendous amount. You alluded to earlier at the outset of our conversation today about the technical side of what we provide. Well, we also have what we call tax wealth
Oh yeah,
management.
talk about that. That's
We have
fascinating.
it is, it's amazing because uh, we had the AI learn the entire tax code. We factored in and had it learn all of the different plan approaches that we utilize and we will utilize, because we'll have it learn those as well as we're finding other plan approaches that we want to utilize after they've been vetted and proven through independent counsel that we work with. But the advisor would be able to tap into just about any question that they are curious about, and they're going to get a very substantive answer in a very, very quick time frame. And it helps guide them to better serve their clients. And it also gives them a really good ideas to the different plan approaches that are available, which would be most effective for that given type of transaction that they're dealing with.
So let's say I was a financial planner and my client comes to me and says, "Hey, I'm 75 years old. I've had this building forever. I want to sell it. It's worth about 5 million. I bought it for 500,000. I'm going to have a huge tax bill. Uh, what solutions do you have? What can I do to mitigate this tax bill?" And the financial planner can just tap into your, excuse me, tap into your AI tax wealth system, and boom, there are the answers.
Well, there are they have the answers for consideration. Again, you want to make sure that whatever's done is customized and tailored to their specific client's needs. But it's a starting point for discussion with the client, and that's really important. As I said, there is absolutely no one size fits all for everybody. That does not exist in tax planning or real tax planning. From having been in the financial planning world for 4 years, I know it pretty well. Most planners out there, they're going to look at maybe invest into an oil and gas deal that might give maybe up to a 90% or so tax deduction. That's fine. But that's not going to give you the kind of leverage you really need. In really true effective tax planning, you only want to use the dollars you would have otherwise given up in taxes to help solve the problem. So, for example, I have a client with $1 million taxable. He lives in Texas, so he pays no state tax, but he's in a 37% tax bracket federally. So he pays $370,000 in taxes. Well, we used one plan approach, used 100,000 of the 370 he would have otherwise paid in taxes, solved the problem entirely, eliminated the $370,000 in taxes, which released now the remaining $270,000 in taxes that he no longer has
Wow.
to pay, that he gets to reallocate and invest wherever he chooses. So if that person came through a financial planner or a wealth manager or somebody like that, that's $270,000 more that could be reallocated for that client's needs and investments or wherever it's appropriate to be
So,
put.
if a financial planner is part of your tax wealth alliance, is that what it's called? okay, if they're part of your tax
Yep,
wealth
tax wealth
alliance,
alliance.
um, and they bring you a client, do they participate in any fees or anything?
They do.
Okay,
They do, depending upon how much participation they are working in it. Uh, we have some advisors who just give us a name and a phone number, sometimes as well as the email address. The gentleman that we talked about that had the real high tax problem, that came from such an advisor that did not participate at all in the process. Just gave me the name and an email address and
got
told me to call him.
it.
Emailed him, and he we got together and we went through the process. But even then, the referrer is still going to participate in the planning fees
Got it.
that we charge. Now let's talk about the planning fees as to how we approach that. Most tax planners out there are very much aligned with what the attorneys who do um, call it accident attorneys, where they charge a percentage of the reward, oftentimes 30 or 40% of what the reward
Right.
is that they get from the insurance company, largely. Well, a lot of tax tax planners out there, that they do the same thing. They have the same model. So it's not unheard of that the client's going to pay 30% or more of the first year's tax savings as the planning fee to solve the tax problem. I think that's egregious, in my view. I think that's way too much. I think it's unfair to the client. So although we are paid through tax savings, we choose to base it upon a flat fee on a range of tax savings. So let's take that gentleman with a $4.8 million taxable, or tax rather, not taxable, but tax. All right, we solved the problem. Originally, it was 6.9 million in taxes he was going to pay, but he himself found some losses on some stock transactions that he had that was able to be used to offset that, and brought it down from 6.9 million down to 4.8 million in taxes. Well, had we solved the 6.9 million, the fee would have been $250,000 as a flat fee. But because it was went down to 480, it dropped to 100,000. Well, if you look at $100,000 fee compared to the tax savings that we were able to generate for him, that's a 2% factor of his tax
That's
savings.
incredible. Yeah,
That's fair.
true.
That is fair.
So this all sounds fantastic, Bruce, and that's why I wanted to interview you because I people need to hear this. I can't wait to send this to my clients and post it on YouTube so the world can hear your story. If I was a financial advisor or a CPA and I wanted to be part of the Tax Wealth Alliance, what are the next steps?
Go to our website. It's taxwealth.com. And there's a lot on there that I think they'd appreciate seeing. It gives them a very clear view as the kinds of tax planning capabilities that we offer, and also what we offer in support of the advisory community out there. We are national in scope, have been for quite a few years, and we're here to serve.
So
We're here to support.
I'm going to post all your contact information, website, everything, of course. But is there a link specifically for advisors to join Tax Wealth Alliance?
At the On the landing page of the website, at the top right, it says
Got it.
"Become a Partner." Open up that link, and they'll learn about Tax Wealth Alliance, as well as the general advisory community that we work with as far as the network. And also, we haven't made this available yet, and probably won't until the early part of next year. But that's Tax Wealth Accelerator. That's for the advisory community. That's where we actually do the marketing for
Awesome.
them.
So this will be kind of rolling out through the end of the year to the beginning of the next year.
Well, Tax Wealth Alliance, actually, timing is timing, right? Tax Wealth Alliance, we're actually uh, officially
Oh,
opening that up
fabulous.
next week. We've worked on that for well over a year in preparing the structure and everything that goes with it, and there was a lot that has gone into it. But I've decided that I wanted to wait until everything is in place. I'm the type of person who likes to dot the I's and cross the T's and make sure everything is absolutely in place before we release it. And we're at that point, so it'll be released
Very
Monday.
important. Um, well, my advice to any excuse me, CPAs or financial advisors, uh, go on to taxwealth.com, review the information, and consider becoming a partner with Bruce and his team. You will be a hero to your clients if you can have some actual proactive pre-sale tax planning to bring your clients. I mean, they're going to look at you like a hero, and I'm sure you're going to get tons of referrals. I mean, imagine if you're a financial advisor and your client needs to sell a big building, and you save them the capital gains taxes. This guy or gal is going to talk to all his friends about you, the financial advisor that's part of the Tax Wealth Alliance and on Bruce's team. Don't you agree?
I certainly agree with that. Again, having been in that industry for quite a few decades, uh, the largest or the greatest challenge that an advisor has, frankly, is finding
Right.
their next client. And so, well, what they don't realize is oftentimes their existing client base is their next client. It's a matter from the tax plan viewpoint in how to solve the tax plans to release more cash flow that's tax advantage, as well as more lump sums amount of taxes that would have otherwise been paid that can be reallocated. I think it's also important to note for the CPAs and the enrolled agents and the accountants of the world out there, we're not in competition with them. We're here to support them. We're here to bring value add to their practices that they can extend to their clients and just give more capability in solving their clients' tax issues. So it's something that is really designed to be nothing of benefit. And that goes back to my basic core of who I am, and that's serving. If you serve, you're going to do well anyway. That's going to come, but you
Great
serve first.
advice. Well, Bruce, I want to thank you very much for coming on our interview today. I know this is going to be very valuable for the audience watching this, especially anybody who's facing, capital gains tax problems or is maybe a high earner, W-2 or whatever, and they need some help with minimizing their income taxes. So, again, Bruce Jones from Tax Wealth and the Tax Wealth Alliance, I want to thank you for your presence today. It's been wonderful. And I will be posting all your contact information on the video. And any last words for us?
No, well, first of all, thank you for inviting me, Derek. I really appreciate it. And all those folks out there that are listening to this, uh, check it out. It's well worth checking out at the very least and finding out what your options are. That's the first step, is to find out and identify the tax problem, where it stems from, and then work with somebody who knows what they're doing in proactive tax planning, whomever that is, to find out what your real solutions are that you can consider implementing to maximize what you need to receive and can
Awesome.
receive as
Great
well.
advice from the great Bruce Jones of Tax Wealth and Tax Wealth Alliance. We'll see you all next time, folks. Take care.